Tom Lee, everybody's favorite bull, was on CNBC a few hours ago speaking about a whole host of subjects on the market, what's going on right now, the sell-off, where he expects the market to go over the next few weeks, over 2024. I recorded this on Fubo for you guys. We're going to go ahead and watch it, react to it. Appreciate y'all joining me. As always, thanks so much for being here. Thank you for being subscribed to the channel. I want to jump straight into this one here today. Appreciate y'all.
Welcome back.
Thank you, Scott.
What do you think? We just got a little, ahead of ourselves, or I don't know. Maybe we just need a breather because it's been remarkable.
Yeah, that's right. I wouldn't be surprised if there's some profit taking today. I don't think it changes the case that stocks are probably going to do very well between today and the end of the year, and we get a pretty important report on Friday, which is PCE deflator.
Yeah. You surprised that this market has continued to just ramp higher, almost unabated?
I think there was a sequence of events that justify the move, because we know last week we got a Fed that has made a dovish move, ending its inflation war or shifting it towards managing the business cycle. We know that 65% of fund managers are underperforming their benchmark, and we know $240 billion was pulled out of equity. 65%. So between now and year end, which is a small window, you do have fund managers trying to catch up, and I think a lot of investors reorienting their portfolio towards a nicer Fed, a less hawkish Fed. And I think stocks are up. Investors need to allocate to stocks.
Unless investors need to take a breather themselves. I had a conversation yesterday with Eric Johnston of Cantor, who's been as bearish as you've been bullish, and told me he just can't show up now and all of a sudden change. Here's why.
I would not be able to come here and say high conviction bullish based on the current multiples, where we are in the cycle, where earnings are, where positioning are. Is just not even close. Okay, what I would need is to see either a recession or close to a recession where people think that it's coming. We get a big growth scare, and the unemployment rate starts to go above 4%, a little bit of a cleansing, and lower prices.
In other words, you're going to get all bulled up, even more so now with multiples expanding to where they have?
Well, as you know, valuation isn't really why anyone should ever sell a stock, nor why they should buy a stock. It really should be whether earnings momentum is accelerating. And next year, it looks like capital spending is going to pick up. There's a lot of surveys showing this, and there's a gap between the hard and soft data. So there's a CapEx cycle. We also know mortgage rates could drop to something like a 4.75, 5.2.
Woo, that's a big statement. 4.75, 5.2 mortgage rates. Oh my gosh, in 2024? Real quick here, that Cantor Fitzgerald gentleman, he's making one of the cardinal sins of stock market investing. One of the cardinal sins. This is the cardinal sin of wanting stocks to go lower so then you can buy in, right? Because at the end of the day, that's what he just explained. I want to see unemployment above 4%. Well, we're almost at 4%, by the way. It's like 3.8, 3.9. It's almost there. That's meaningless. He just basically wants the market lower. That's all he wants, right? Market is going to make moves when the market wants to make moves, not when you hope it makes moves. If all of a sudden we talk about a situation where earnings start ramping up significantly in 24 and then go into 25, a guy like that's going to have to buy at S&P 500, 5,500, 6,000 at that point in time, right? You need to be able to look out there and say, this is an opportunity, this is an opportunity. Not, I hope it goes down. That's not an investable strategy.
That's not ahead of ourselves a little bit.
That would be taking a normal spread to the current tenure. And that 200 basis point drop in mortgage rates, we know, would stimulate the consumer and reliquefy regional bank balance sheets, which is an earnings story too. So I'd say earnings momentum picks up next year. We have a Fed that's trying to at least maintain the business cycle. And investors are bearish. There's a lot of anchored views. We just heard one clearly articulate that they're going to only turn bullish if there's a recession.
Yeah, but I feel like the bears are kind of dropping like flies now,
yeah.
Right? I mean, there aren't...
And listen to you. Sometimes I wish bears would just listen to themselves. They're going to get bullish because of a recession. Like I wish they just listen to themselves sometimes. I'm going to get bullish when there's a recession. You don't know how deep the recession goes. You don't know where the unemployment... You might say, unemployment's now at that 4% number where I wanted it. Well, now I can buy. Dude, unemployment could go to 10%. And it could happen quick. That's just ridiculous.
Aren't that many of them. I've seen some strategists who were very bearish over the course of the last year suggest, stocks can continue to go up. This Fed pivot is that powerful. The other side of that, though, is what Eric Johnston and others would suggest, that it's a little too early to think that earnings are going to live up to all of this hype. A lot of hype that you have. I mean, your earnings number last time you came here, the best case
for 2025.
Amazing case.
Yeah.
Unbelievably incredible case was like $280.
But
Do I remember that correctly?
Yeah, you are, Scott, but that's not a prodigious feat. It's about a 10% CAGR. So it's like saying 5% from buybacks, nominal GDP, and weaker dollar get you there. I don't think it's a lot to ask to get to 280 in earnings.
I love the way Tom Lee just puts that, right? Because it does at first sound, oh man, and then he's just like, here's how we get there. Doot. I love that, man. I appreciate that.
But I think most importantly, the market internals don't speak to what happens at a top. This is really early cycle behavior, a huge expansion of market breadth. Stocks really peak when you get good news and they go down. We haven't had good news. I mean, today's sell-off isn't off some great headlines. It's
true.
Year-end rally.
Do you think the market is at all ahead of itself in the idea that...
And what Tom Lee said there is so important for everybody watching this video right now to understand. He is saying that the way the market's behaving is more like an early stage cycle than late stage cycle. Everybody on Wall Street, 98% of these guys and gals, are convinced we're late stage cycle and it's just about when's a big recession crash. Is it 5 months from now, 10 months from now, 15 months from now, right? Why didn't it happen in 2023? They're all in this late stage cycle game thinking it's about to happen. It could be we were in an early stage cycle. It could have been this was 2009 and we're about to go into 2010 right now. It is a potential, right? Consumer sentiment, look at consumer sentiment survey. Look at small business index. Look at it versus 2009. It's been arguably worse. It actually has been factually worse than it was in 2009. Factually, in the past year and a half.
As one would like to think, based on what happened, at the Fed meeting?
I think the Fed is trying to figure out how to communicate future cuts. And the market's going to get anxious about it in the first half of next year. That makes a lot of sense to me because we're going from a data-dependent fighting inflation now to under what conditions does real rate get defined and when should we titrate that and cut rates? I think that's a debate in the first half. That's kind of why our 2024 view is most of the gains happen in the second half.
Do you think we're pulling forward gains at this point?
Yeah. I think December is going to end up very strong. And I think the last time I was here, I thought it could be parabolic, which it does seem like it's going parabolic. But a move like that isn't consolidated sideways.
Wow, look at that 10-year.
Maybe there'll be some payback in March or April.
I just want you to hold your thought for just a moment. I want to bring in John Spallanzani.
So Tom Lee and I, we might disagree a little bit there. I believe we are going to see weakness in the market at some point in Q1. He's thinking more March, April. I'm thinking more at some point in January, February. Assuming, let's just say market starts ramping back up for here in December. I think January, February, they're gonna have some sort of big drop in the market. They'll blame it on whatever, but really, I just think there's going to be a lot of people that want to take some profits, kind of around either January or February. That's just my
family
opinion.
Office who is a portfolio manager there. He
watches
the market like a hawk.
This guy does a great job of explaining kind of why the market dropped, in his opinion, here today substantially in this last couple hours of trading.
What do you make of what's happened here within the last 30 minutes or so, of what you think is a culprit of this sudden sell-off? If there is one, anything more than just saying, hey, we've reached some pretty lofty levels, let's just take some chips off the table for a minute and catch our breath.
Hey, how you doing, Scott? Hey, Tom, how are you? Hope all is well.
Somebody got slaughtered at the stock exchange. Did you hear that?
There was some big prints in the zero-date options, which is not a surprise. It's an expiration today. There's about hey, Tom, how are you?
This guy's calls expired worthless. Listen.
Levels. Let's just take some chips off the table for a minute and catch our breath.
Hey, how you doing, Scott? Hey, Tom, how are you? Hope all is well. So it just seems like
my call.
Big prints in the zero-date options, which is not a surprise. It's an expiration today. There's about a 500,000, almost 1 million calls and puts that printed a little while ago, right before the sell-off at the 475 strike. So that was also the VWAP level, which is, for those technical people, the weighted average price that guys are pegging for some orders. And then once we took out 475, it seems like the selling just got selling and knocked us down 50 handles here. So, we had a stair-step rally with nothing really hitting on the VWAP all the way from really kind of, probably the 5th or 6th of December. So once we broke the VWAP,
Okay, before he goes further here, because he's explaining some high-level stuff here, let me explain a little bit lower-level stuff on the market in a bull market and what you see in a bull market versus a bear market, okay? When you're in a nasty bear market, what you see is most days the market just seems like it goes lower and lower. You open up your portfolio, and if you're net long, you're like, I'm down again today. You wake up the next day, I'm down again today. You wake up the next day, I'm down again today. And then you wake up one day and it's like, whoa, it's a huge day up, right? And you start saying, okay, maybe we're getting back bullish again, baby. And then the next day, down again, and down again, and down again. That's a bear market. A bull market on the flip side is, up. It seems like every day your account's going higher and higher and higher, almost every day, right? But then you'll get some huge, just downswings out of nowhere, right? And those big downswings, whether they last for a day or a few days or even a few weeks, the bears come out of hibernation. They get real excited about it. Oh, I told you the market's going lower, right? They kind of fall for the trap a little bit. There's a little bit of a bear trap, and next thing you know, you roll higher, right? So that's kind of more what this feels like. And, as somebody that's been in the market since the great financial crisis, I've seen a lot of bear market, or let's just call it this. I've seen a lot of bear traps over the years, a lot of them. And, it would be the market just kind of rolling higher, and then all of a sudden you get a nasty day or nasty few days. Bears come out of hibernation. They start talking about all their bear points, and then next thing you know, market just goes higher and higher and breaks a new high.
Guys got to sell, and the options, the 0-day guys just kind of piled in.
I think it's just like maybe a little bit of an air pocket for a moment there.
Yeah, it seems so. Volume obviously is lighter as we get closer to Christmas. People taking off, and it was definitely an air pocket.
That's a good point. It is. Right now, the volume starts to dry up. It does. I mean, we're today was December 20th. As you get further and further in this week, volume dries up more and more. Next week should be very light on volumes. And so you can have these kind of freak situations where the indexes get pushed around a little bit because volume's really, really low, usually around these kind of 2-week period here.
We went up 50 handles pretty easily from 475 to 469. But, some people said that there was a couple of stories out there that might have done a couple of tweets that might have been put out there. Some China, some other stuff, but I don't think it was that. I think it was more, the technicals and the 0-day options, which everybody's been talking about for a long time, where, you have, huge gamma levels. I mean, you could imagine what 1 million options that are expiring today, how much the hedge is if you got that trade wrong.
That's true.
So that's kind of...
Right.
Yeah.
That's like the latest and greatest trend as we're learning, I think, more and more.
So one of the super scary tweets he's talking about that was out there circulating, it was in regards to China. And the tweet was something around the lines of Xi supposedly told, President Xi supposedly told Biden that, he's got to take Taiwan, even if it's by force. Who knows? Rumors, okay? From what it seemed like came out of that, it was more positive, friendly type stuff. Sometimes you see one of those tweets and you're like, who needs some puts to print money?
In options trading, whether it's from the most experienced people who are out there to more novice investors who are trying their hand at options trading as well. I'm going to let you run. I think you're with me tomorrow anyway, so we'll catch up about the rally, where we think 24 is going to go. John, thanks for calling in. I just wanted to get some insight. Yep, just wanted to get some insight on just tick by tick here as we head over the final stretch. At this point, the market's come so far, so fast. I mean, bar's high. I mean, there's a lot now to live up to. You got to have the cuts when we think we're going to have the cuts. You got to have earnings live up to what now expectations are going to rise to. You got to have the economy hang in there to justify the multiple. You got to have rates come down to help justify the multiple. Is it too much at some point?
Well, you're describing a great wall of worry, and as you know, markets climb a wall of worry.
I know, but it's like maybe a wall of reality, too.
Well, I'd say that at the start of this year, a lot of the bear arguments you played for me earlier were exactly what people said on January 2023. We're going to have a hard landing. You can't buy stocks until employment goes up. Earnings are going to be disappointing, and the year played out, earnings were good, and we didn't have a hard landing. Look at labor supply, it's growing now, so I don't know if unemployment has to go up, and inflationary pressures are decreasing. Look at UMich, the Consumer Confidence Survey today. They're back to October 2020 levels. I mean, inflation is disappearing from consumer expectations. So I'd say that there's the thing that the bears might get wrong is multiples.
What I tell you guys, I said watch consumer confidence come back strong over this next 6 to 12 months. Watch small business index confidence come back strong this next 6 to 12 months. Watch real wages come back strong this next 6 to 12 months. You just watch.
Do a lot more.
The column is out for the last several months.
Expect next year.
All right, let's bring in Christina Hooper, sitting here as well from Invesco. This sudden move aside, what is your view as we...
And it's important to understand this woman's view that she's about to give here, because she is an important individual at Invesco, okay? When we're talking about these sorts of individuals, you got to understand who's really controlling the big money. You know, Invesco, big dogs.
Race towards the end of the year here with these extraordinary gains.
She's feeling good? That's good.
Well, I think the key is that monetary policy, really since the Great Recession, has had an outsized impact on markets. It's really been such a critical driver of markets. And a perfect example of this is what we've seen this year, and especially what the Fed has communicated. If we look at the September dot plot, that implied 50 basis point cut after an implied 100 basis point cut in June was the start of a big rise in yields. And now, of course, we're getting the Fed communicating finally that we have actually seen the end of the tightening cycle in July. And that has had an outsized impact on markets, as it should, because monetary policy has been so important.
So you say it's so justified. I mean, we to your point, is we have, as an investor class, become conditioned to the don't fight the Fed, because we've learned how powerful it could be after 2008. And anytime there was any, crisis of magnitude, the Feds had our back. And the time they didn't, we had a terrible year last year because they were raising rates rather than cutting them. Now the paradigm has once again changed in our favor. That's the argument you're making. So this is all justified, the way the market's reacting.
Absolutely. And the economy is cooperating, right? We have an economy that has been quite resilient, and we also have disinflation very much underway. People were very skeptical earlier this year, and I think finally in the last few months there's a realization that the disinflationary process is happening. It's very significant, and we will ultimately get close to that 2% inflation target within a reasonable period of time.
Yeah. What about the broadening? The Russell, I spoke too soon, of course, when I said it was hanging on still a positive, because now it's rolled over with everything else. It's down about 0.5%, but it's been a remarkable run. The Russell, even with today's pullback, is up more than 11% over 1 month period of time.
Oh, absolutely. And I anticipate a continued broadening of the market. And I think small caps are going to play a critical role, as are cyclicals, because what they're doing and what the market typically does is it's discounting an economic reacceleration in the back half of 24. So it makes sense that the more cyclically sensitive parts of the market are performing better.
This is your playbook.
Yeah.
So, okay, this woman, chief market strategist at Invesco, important person at Invesco, a big money player in the market, right? Let's call it the way it is. Is she going bearish, or is she going bullish, or is she going neutral? The answer to that is she's going bullish. There's no dang doubt. When you listen to all the words she just said, when you listen to when you look at these bullet points, yeah, she's definitely going bullish.
That's right. And then, when it comes to valuations, I mean, S&P 600's, 11 times next year's earnings. I mean, you could see a lot of multiple expansion there. That's why I think small caps could rally 50%, next year.
Yeah, something you continue to make that case. At the expense of what? At the expense of what?
Well,
most people.
By the way, if Tom Lee's right about that 50% call on small caps, legendary call. I'll give him that. Because I'm bullish on smalls, but I'm not that bullish. That's a whole different level of bullish. 50%? If that man's right about that, legendary call.
The expense of maybe mega cap?
Yes, I think that's probably correct. That mega cap, actually, someone pointed out, and I think I actually checked it was correct. FANG's actually cheaper than it was at the end today than it was at the end of 2021.
100%. Yep.
Because earnings have gone up like 30% and the price level is only up 2%. But next year, the multiple can be harder to expand for the FANG, so it's just more EPS growth. whereas things like financials and small caps can see 50% increase in multiples plus earnings growth. So I think you're right. I think that if you're talking about PE expansion, it's more the small cap names.
How do you see that?
Well, I think it's at the expense of cash. It's at the expense of a lot of different asset classes. But where Tom and I differ is that I don't know what is going to happen in the back half of this year. In fact, I suspect what we're likely to see is a leadership shift and more of a focus on defensives and quality because markets will be discounting 25. And maybe that's...
Not to mention a presidential election where who knows what's going to happen, big wild card. How messy it might get.
Big wild card. It's going to get messy.
Just don't know.
Right, and let's also
it's
not forget
be mud pie messy.
The long and variable
real
lag
messy
of monetary policy. So if we use that rule of thumb that it's 12 to 18 months between monetary policy implementation and when we see it show up in the economy, well, that could mean it really hits in 24. We really don't feel the cumulative effects until the end of 24. So could we potentially see that recession in 25, which markets could potentially start to discount in the middle of 24? I don't know that yet. We just don't have enough visibility.
What if, I saw a headline, I think, earlier today from the Fed's Harker saying that, the economy's slowing faster than the data is suggesting. What, in fact, if that is the case?
Well, I think, one, that sets up for a growth scare in the first half. And it sets up for the market to really be debating with the Fed about what they should be doing. I would say that makes sense. That's why I think the first half isn't where you make your money next year. But does the Fed have the tools in place? Fed funds is at 5.
That's important. Tom Lee says the first half's not where you make your money this upcoming year. I can't say I disagree with it. Like I said, I'm still expecting a big pullback at some point in the first quarter. So, yeah, I can't say I disagree with that.
1.5%. They could do a lot of cutting. And they have a lot of tools to really stave this off. So
but part of I would like to believe that part of the bull case is, yes, the Fed's going to cut. It's going to cut because it can. It's not going to cut because it has to. You're painting a scenario in which it doesn't matter. They have the tools. If the economy slows worse, if it looks like we might go into a recession, well, they're going to cut, so that's positive anyway. Is it really, though, if they cut for that reason?
It is, because it's one thing to be slowing if the consumer and corporates were over-levered. They're not over-levered today, but they're paying a lot of money to borrow money. So it's a cost of money issue that's slowing the economy. So if the Fed cuts rates, you're actually alleviating the biggest pressure valve on growth. So
but how do we justify multiples if the Fed cuts rates because the economy's gotten that bad?
Well, it's actually, that's one perspective, but the reality is they're cutting rates because real rates are too high. That's really it's not appropriate to be at 5.5% if inflation's running at 2%, because you're running a real rate scheme that causes a recession. And I think
that is true.
In fact, if we're slowing, it's proof that the real rates are actually too high right now relative to inflation, right? Inflation's tracking at 2%. So,
that's a good point. I'll put it like this, right? When let's say CPI was at 7%. The Fed's in a situation where they're playing catch up. So you got to keep raising rates, right? If you're at CPI of 5 and you're at Fed funds rate of 5, you're kind of looked at as like equilibrium. That's good. You're healthy, right? If suddenly CPI is 2 and you're at 5.25 or 5.5 or 5 or whatever, there's a huge divergence there. So it looks like, if anything, you're trying to cause a recession. You're trying to cause deflation because your Fed funds rate is so significantly above the CPI at that given moment, right? So this is why, the Fed could be looking to cut especially as we get closer and closer to CPI 2. If we get core closer and closer to 2, then, that's definitely a moment that they would be looking to cut, right? I wouldn't predict that for sure they're going to cut in March, like a lot of people are starting to expect. Over half the market's now expecting March cuts. I wouldn't go there. But, there's no doubt the potential is that a cut comes in 24. But if inflation stays a little higher and the economy stays really good and the stock market's rolling and earnings are rolling, then there's a potential the Fed doesn't even cut the whole year, or they cut at the very end of the year or something like that.
I think that there's going to be a bear argument, but to me, it's actually perfectly in alignment with the idea that inflation's falling, real rates are too high, the Fed actually has to make cuts. But that's a debate in the first half.
The idea that, there's no way this market is pricing in a recession. No way. We've already placed our chips all in the middle of the table that we're going to have a soft landing. we're placing our bets that the Fed's going to cut because they can, not because they have to. If they have to, does that change the whole paradigm about the market?
I think the question is moot because they don't have to this year. I think they're
in 24, you mean? This year, you
yes,
think
exactly.
24?
I think they start to cut in the second quarter because they should, because they admit they are in restrictive, very restrictive territory right now. And so the reason for cutting is the right reason. Again, I think that what is undecided at this point, undetermined at this point, is what happens in 2025. But I anticipate something of a bumpy, brief landing in 24, a mid-cycle reacceleration, and then we could see more problems in 25. But it remains to be seen at this point.
What about, Christina, fixed income? Where are people supposed to be right now?
Well, if you anticipate a bumpy landing, as I do, I think investment grade credit looks really attractive. Also, emerging market debt. It's a supportive environment in emerging markets. We're seeing a dollar that's weakening. I think that's going to continue. So those are two areas that are attractive. In terms of duration, long.
You have a view of that real quick before I go?
I think all that makes sense. I think bonds are going to do pretty well, but of course, if bonds do well, PE goes up. Right.
See, that's why you have a big smile on your face as you finish that statement. Thank you, guys, very much. Happy holidays to you both. We'll see you on the other side, I'm sure of that. Christina and Tom. All right, let's send it over.
Very well. That might be it for Tom Lee for 2023. We might not see that man again until 2024. We'll see. But yeah, we might not see him for a while. So appreciate them sharing their thoughts there. And obviously Tom Lee kind of sharing his thoughts. And man, I'm telling you, if he's right about that 50% move for smalls, it's so legendary. I'm kind of thinking, maybe more 15%, 20%, something like that. If he's right about 50, woo-wee. Oh my gosh. Oh my gosh, that's all I got to say. Holy smokers, that will be no jokers, all right? Appreciate you all joining me as always, obviously with all these debates about what's going to happen next year. I put together about a 45-minute video for you guys. Pin comment down there for access to that. Enter in your email. I can send it over tonight or send it over tomorrow, something like that. It's a 45-minute video that goes all into how I plan to invest in 2024. Very detailed video there. So hope you get a lot of value out of that and really enjoy that one. It's absolutely free to access it. So pin comment down there. All right, guys, much love as always and have a great day.